In this video, we're going to take a look at the dollar Japanese yen exchange rate and why this continues to be a really popular market for foreign exchange traders around the world. Hello, I'm David Jones from Capital.com, and this is the latest in our series where we look at popular financial markets with traders. In this one, we're going to look at dollar yen in a bit more detail. I think this is always an interesting market. You know, euro dollar is widely traded. Pound against the dollar is another popular one. But with dollar yen, we're looking at the Asian economies maybe versus the US economy. So we're stripping Europe out of the equation. So let's get into it. Let's take a look at what makes up dollar yen, why traders like it, and what sort of volatility can we expect when we're trading this market. So let's take a look at what is the dollar yen currency pair and why is it so popular? Well, put simply, it's the exchange rate of the US dollar to the Japanese currency, the yen. For example, if it's trading at 110, that means that $1 buys 110 Japanese yen. It's tight spreads because it sees a lot of volume, this market. So the spread is the difference between the buy price and the sell price. So tight spreads here means the cost of doing business is relatively cheap. And the volatility that we see in dollar yen makes it a consistently popular market with traders. So how do you trade dollar yen with Capital.com? Well, you trade contracts for difference, CFDs on the dollar yen exchange rate. You may be familiar with CFDs, but just as a quick recap, you can trade using leverage. So what leverage means, it's a popular approach with many traders over the years. A smaller sum of money can control a much bigger financial position. So what this means is you have the potential to magnify your profits when you're right. But of course, hand in hand with that goes the risk of magnifying your losses when you're wrong. So it's very important to use risk management controls such as stop losses to make sure you're not going to run up too much of a loss if the market doesn't move in your direction. And also importantly, with CFDs, you can trade markets in both directions. If you think dollar yen is going to go up, the dollar is going to appreciate, you can buy using CFDs and hope to sell out at a higher price. If you think, though, the dollar is going to fall against the Japanese yen, you can sell short. So you can position yourself to profit from a fall in the exchange rate. So the thing to take away here is using CFDs, you can trade markets in both directions, and that flexibility is very important for traders. Let's take a look at some of the typical volatility for dollar yen and see why it is such a popular foreign exchange pair. So here's the chart for dollar yen. This is going back about 18 months just to look at the bigger picture. So the market traded as high as about 115 in November 2017. Then about 5 months later had dropped down towards 105. Big swing back up again. And again, you can see plenty of swings there. Let's take a look at the shorter term moves though. So this is just over the last day or so. And you can see there's been a big swing with the market going from just below 110 to down towards 108. So almost a 200-point move there in dollar yen in not much more than a day. It's quite an extreme move, but it is this sort of volatility that attracts traders to currency pairs such as the dollar versus the Japanese yen. So as ever with foreign exchange, tight spreads play their part. The cost of trading is low. Plus the sort of volatility we see in these markets, because they get moved by so many different economic, fundamental and political events, means they continue to be really popular markets with traders around the world. You can trade it through Capital.com using CFDs, contracts for difference. You're trading using leverage, so you've got the potential to magnify your profits, but hand in hand with that is the risk of magnifying your losses as well. So as I said, it's very important to use risk management techniques such as stop losses. Plus, of course, you can trade markets in both directions, which is very important. If you're a short to medium term trader, you need the ability to try and profit from falling markets, and that's what you get with CFDs. You can find out more about that on the Capital.com website. We'll start wrapping up this short introduction. If you're watching it on YouTube, you can subscribe to our channel and click on notifications to always be alerted whenever we upload new content. But for now, from me, David Jones and Capital.com, good luck with your trading.